Welcome to the fourth and final US report from Barnett Ravenscroft Wealth Management. We've been finding out how investors here in the States are increasingly turning away from actively managed funds in favour of passive funds instead. So, how do you go about it? We've been asking for the advice of some of America's top financial experts.
Start with taking the whole question seriously. And I think that leads you almost immediately to saying, well, I better understand myself, shouldn't I? And understand your financial situation. Put it down on paper, one side of one sheet of paper.
So your emotional tolerance for risk is a critical part of what should go into how you allocate your money when you invest, and also how you make decisions going forward. Because someone who has a higher risk tolerance, who can accept more volatility and uncertainty, in the long run should be able to develop a portfolio where they get higher returns. Of course, there's always a trade-off in finance, so the higher returns that you enable yourself to get come at the cost of more risk, and if you're investing in a broadly diversified portfolio, essentially more volatility. Well, I think most people really should have an advisor. It takes quite a bit of discipline and a fair amount of knowledge and education, and of course the vehicles need to be available to implement whatever strategy you're going to follow. And so I think it's hard for most people to have all of that and put that all together.
Investing is really pretty simple. First, the key to investing is starting to save early, because time is your friend.
Recognize that you're going to live longer than most people plan for. Mid-80s is not at all a surprising number. 90, 95 shows up. There are more and more people that live to 100. And then recognize that you're going to be an investor for a very, very long time.
Don't think you're smarter than the market, because impulse is your enemy. And when are you most optimistic? If you're an investor, when the market's at an all-time high. When are you most pessimistic? When the market's at an all-time low. Well, if you buy at the highs and sell at the lows, reflecting your behavior, you're going to have a very unprofitable financial life. Keep your emotions out of the way. Don't peak is one of my rules of investing. And then go the passive investing route, owning the market, bond market or stock market, pretty much in its entirety, and capturing whatever returns those businesses actually earn.
There are managers who outperform the market, and I'm not going to say that there aren't people who can't beat the market. That's not my message. My message is the probability that you are going to do well is not with active management. The probability that you are going to do well is with indexing. But there are managers who have beaten the market. The problem is when they beat the market, it's very difficult to determine whether they did it because of skill or they did it because of randomness.
I don't try to pick stocks. I know that if there's somebody out there that can pick stocks, I know it's not me. I think the data are overwhelming.
You want to be a little careful on asset allocation, and my view is you want to be quite heavy in equities or stocks when you're young because you can afford the risk, but when and you're relying on human capital for your income. But when you get older, you're through working, you're retired, you have to rely on your investments for capital. Your human capital is spent it all self over a working lifetime. And so at that point, you want to make sure you have a decent income coming in rather than all the speculative capital kind of stuff that the market gives us from time to time. And so that means you have to rely more and more on bonds.
We believe to an overwhelming degree investors are not aware of all of the dimensions of risk and return that the capital markets are offering to them, and they are not taking advantage of those risk dimensions in their portfolios. And we think most investors would be better off to have at least some portion of their capital in all of these various risk dimensions.
There's a rule in real estate that the three most important things are location, location, location. Well, my rule in investments, the three most important things are diversify, 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 and then I'll give you three more: keep costs low, keep costs low, keep costs low. And The simplest way of doing that is a very broadly diversified, very low-cost index fund.